The next speaker is Salia. He has 10 years of experience as an IT professional developing software, and then about 12 years additional experience in the reinsurance industry, performing analytics, predictive modeling, reinsurance optimization, economic capital model development, catastrophe risk modeling, risk management, and actuarial pricing. He regularly contributes articles on the insurance and reinsurance industry to professional magazines. Salia, over to you.
Thank you, Sharad. So let me share my screen.
Salia, your volume is a little bit low. I don't know if that's only for me or...
how about now?
Yep, much better.
Yep. Let me... Can you all see my screen now?
Yes.
Okay, good. Yeah, first of all, thank you for your kind introduction and then giving me the opportunity to present at the GI conference today. So there were a wide range of topics being covered today. So I thought that the day wouldn't be complete without talking about the reinsurance market and reinsurance industry. So probably most of you have heard about, like the hardening of the market through news articles, articles and news items. So how does it actually impact insurers? So it's not going to have an impact only on the insurers, but it can have impact on policyholders like you and me, because it's highly likely that insurers are going to pass down additional costs to policyholders. In fact, if you look at the primary market nowadays, it's actually showing signs of hardening as well. So in this presentation, I'm going to cover a few items. So I'm going to cover the market drivers behind the hardening of the market and some notable observations from the reinsurance renewals this year and last year. And most importantly, so how to mitigate the adverse impact that it has. And finally, some concluding remarks. So what has contributed to the hardening of the reinsurance market? So there are several factors that we have identified. So one is actually the elevated natural catastrophe loss events. So in the morning that we talk about this the climate changes and the temperature, global temperature is rising. So the natural catastrophe events are happening more frequently and with more devastating impact. So that's one of the factors contributed to the hardening of the market. Then as you know that there's a low interest rate environment prevailing right now. So it actually adversely impacted the reinsurers. So insurers were compelled to look at and underwriting profit margins because of that actually contribute to the upward movement in the pricing. So for the last decade or so that we have seen that the insurance industry has been experiencing soft market conditions, and it actually has come down to a level that some of the rates were not actually sustainable any longer. So luckily in late 2019, the market actually showed some signs of hardening. Then we all know that the COVID happened, the pandemic happened, that actually became a catalyst to accelerate the hardening of the market. So when you talk about the COVID, so we know that the COVID-related losses were actually initially estimated to be over $100 million. So now it has come down, but there is still ongoing, claim development, and uncertainty on those losses was one of the factors. Then in the mature markets like US, you see that there's an increasing frequency and increasing severity of liability classes, losses happening in the liability classes, and there's a loss cost trending higher with social inflation as well, and that was another factor contributing to the hardening of the market. So in the next few slides, what I'm going to do is talk about some of these factors in bit more detail. So according to the Swiss Re Sigma report for 2020 was the fifth costliest in terms of the insured catastrophe losses on record. So as you can see on this graph over here, you can see that the catastrophe losses are actually trending upwards, particularly in the recent years over here. So out of these catastrophe losses, it was about 81 million in 2020. Out of that, over 70% actually came from secondary perils like wildfires, floods. So as you can see that, particularly with this climate change, you can see that these particular secondary perils happen more often. And then in this table, it shows that there's a comparison between 2019 and 20 and comparison between 10-year average as well. So economic losses have grown up by 35%. And then the insured losses have gone up by 41% compared to 2019. And this 89 million insured losses actually is 10 million more than the 10 years previous average. So as you can see that, these natural catastrophe events are happening, have a big impact on the reinsurance industry. And one interesting point is actually that you can see that insured losses as a percentage of the economic losses is increasing as well. And it is actually more than the previous 10-year average. So Mehul actually mentioned that, the insured losses in Asia is about 10% out of the economic losses. But I think it's changing now in a way that, that the policyholders are becoming aware of these natural catastrophe events, especially nowadays, everyone is talking about this global warming, then going carbon neutral, like COP26. So there's a lot of awareness in the market. So that actually can be one of the reasons that, people actually buying coverage for natural catastrophe losses. And the next one is the COVID related losses. So at the onset of COVID pandemic, so the losses associated with COVID was estimated to be over 100 billion USD. But it has come down to about less than 40 billion as of June 2021. But there are still going on, some of the litigations are going on, and there's an uncertainty on these losses. So that actually contributed to the hardening of the market. So as we can see on this table over here, so this actually shows the insurers and reinsurers, global insurers and reinsurers with COVID-related reserve estimates. So the top three are actually reinsurers, each with over 4.4 billion loss estimates. And the next one is the investment market performance. So as we know that the prevailing low interest rate environment had a big impact on the insurers' investment income, particularly in 2020. So with the onset of COVID, so the global economy started to falter, and then the government intervention with stimulus packages helped to actually recover some of these economies, and then especially the equity markets rebounded quickly, and some of them actually reached record size like NASDAQ and the S&P 500. But for reinsurers, they traditionally tend to be conservative with their investment strategy. So any gains in the, let's say, equity market is unlikely to drastically change their investment strategy. So because of the prevailing low interest rate environment and the volatility, particularly the volatility of equity markets, compel reinsurers to focus more on the underwriting discipline and the underwriting technical margins, because they still need to meet their cost of capital requirements. So next, I will talk about some of the notable observations from the renewals in 2020 and 2021. Actually, the market is quite busy right now with the year-end renewals. So as you can see that the reinsurance capital base has been intact. In fact, it has grown in the last 2 years with the inflow of capital. So traditionally, the reinsurance market cycle is associated with the inflow and outflow of capital, but it is not the case this time, as I mentioned in the previous slide. However, having said that, you can still see that there are pockets of markets that actually got impacted by the availability of the capital or the capacity. So particularly the markets which are prone to catastrophic events, actually seeing that reinsurers withdrawing the capital capacity or reducing their capacity. So these markets actually got impacted by the availability of the capital. Then in terms of the price changes wise, so we have seen some modest rate increases. So at the beginning of last year, like there was sort of speculation or the forecast that the rates would change between like 5 to 35% range. But in fact, what has happened is rate increases were generally about 5 to 15% on a risk-adjusted basis. So this is on an overall basis. But if you talk to let's say the cyber underwriter or a broker who's dealing with cyber insurance, they would say that rate increases over 100%, 200%, in some cases over 400%. And so it depends on the line of business and the pockets of markets as well. So the markets like Japan, which had hit by catastrophic events, had rate increases over 20% or 30% in some cases. Then the performance of your treated insurance programs really mattered as well. So the programs that had bad loss experience were particularly hit hard with significant rate increases. Even the programs having favorable loss experience to reinsurers or with loss-free experience had some impact as well. They were not spared. So there were some moderate increases on those programs as well. Then we have seen that, noticed that particularly in the last 2 years, the insurance structures have been changed. More and more insurers are actually looking at how they can change this structure to address pricing concerns. So some of these changes were like increasing deductible, adding cost-saving features. I will touch upon these in more detail later on. Then another notable observation was that the renewal process took longer than usual. So we have seen some of our clients actually indeed started the renewal process early because they have seen that the quoting process has been slow and it has been more complex. The reinsurers, they tend to actually scrutinize the programs more closely, and even for like some of the we have seen that for small programs they had to actually go to their headquarters to get the approval to write those business. And the contract review process has been very rigorous as well, particularly with wordings and exclusion clauses. So at the end, all this add up to this process being later than usual. So as I mentioned that just now, that the contract wordings, terms and conditions actually took a big part of the negotiation process, renewal process. So for example, like communicable disease exclusions, they replace all clauses with a newer process with with more restrictions, and we're actually having broader coverage. And there's another one is like cyber exclusions. Again, the existing clauses were replaced with new ones, and so on. And some of them actually added new clauses. So far we talked about the factors that contribute to the hardening of the market and some noticeable observations from the market. So as an insurer, so how can you basically address, the adverse, mitigate the adverse impact? So in this section, I will talk about some of the steps insurers can take to mitigate this adverse impact. The first one is the data quality. So regardless of the stage of the market cycle, data quality is a very important factor. So what the hardening market has done is actually highlighted the importance of data quality, because with the poor data quality, so reinsurers have to deal with the information asymmetry and then uncertainty with the analysis work that they do. So on top of any hardening rates, they need to actually load for these additional, information asymmetry and uncertainty with the pricing analysis work. So that's very important that insurers, actually put more effort into improving their data quality, because some of the clients that actually we have dealt with, we have seen that because of the poor data quality, some of the reinsurers actually refuse to even quote because they find it actually difficult to, even provide a quote because of the poor quality of the data. So the next one is actually looking at how to change your reinsurance structures to provide cost savings. So one is actually looking at the increasing the deductibles. So for the non-proportional programs, you can look at increasing the deductible to provide cost savings. So increasing the deductible means that insurer will retain more losses, working losses. So we always recommend insurers to actually have proper cost-benefit analysis to determine an appropriate level of retention. For example, actually last year when we did the renewal for one of our clients, so the CEO said that they have a budget to meet for the reinsurance cost. So they had actually, their exposures have grown so much as well. So at the end, on a risk-adjusted basis, when you look at the pricing, it was actually over their budget. So at the end, what we had to do was to drop the bottom layers from their structure in order to meet their budget requirements. So that sort of thing can happen basically. So if you have, normally the insurers have a budget, and their exposures may have grown as well, then basically, you have to look at, how you can actually have cost savings to meet your budget requirement. So there's another feature that you can look at is actually the annual aggregate deductibles. So with the annual aggregate deductible, the insurer will be retaining losses up to the AAD limit before actually they start recovering from the main program. So we normally recommend this program particularly for insurers who actually still want to maintain their expiring deductibles, but looking at cost saving measures. The next one is the loaded reinstatement. So with non-proportional programs, the insurer pay upfront premium. So the upfront premium, let's say that, okay, if you get a loss to your program, then to reinstate, you need to pay a reinstatement premium. So this reinstatement premium actually acts as a discounting factor when you calculate the upfront premium. So higher the discounting factor, you will have a lower upfront premium and vice versa. So typically the reinstatement factor is set at 100% of the upfront premium. So you can actually set it up at something over 100%. In some cases, we have seen that we set it at 110, 120, and 130 kind of range. So they actually will have a cost savings with the upfront premium by doing that. So we normally recommend this kind of features to reinsurance contract having loss-free experience. And the downside of this is actually that, let's say, if you have a loss, then you have to reinstate at a higher, premium than the original upfront premium. And the next one is the option to buy additional coverage only when needed. So when the insurers, when they with their business plan, when they budget for, let's say, the next year or so they face challenges because of the uncertainty in the economic conditions, particularly given that there's a pandemic is still going on. So rather than buying the additional coverage for let's say that if you're expecting a growth in your portfolio, of course you expect your exposures to grow, so you will need additional coverage. So rather than buying that additional coverage at the beginning of your coverage policy, so what you can do is you can buy that coverage only when needed. For example, let's say that your exposure or premium reach certain targets, then you actually buy that coverage. Last year, when Singapore government actually made it mandatory for incoming travelers to buy COVID coverage. So we worked with one of the insurers who actually provided that coverage. So there were a lot of challenges because of there were like constant changes of travel advisories and the lockdowns. So because of that, it was difficult to project what is the income for that particular program. So what we have done is at the end, so we actually design it in such a way that this additional coverage kicks in only when premium reaches certain targets. So the next one is actually, you can look at separating the layers by cover type. So particularly the non-proportional programs for, let's say for the risk losses, for the cat losses, you can actually have different deductibles. So for example, let's say that you have not experienced any risk losses, you can actually set up your deductible for risk losses to be higher. So that's one of the options you can look at. Then the next one is the multi-year deals to lock in the pricing. So typically, when you buy insurance programs, you buy it for 1 year. So every year you renew it. So in anticipation of the hardening markets to continue, you can actually lock in your pricing with this what you call this multi-year structured deals at the beginning of your cover. So these deals are typically for like 2 to 3 years. So you lock in the pricing, so regardless of the loss experience of your program, your price doesn't change. Then another good thing is actually with these programs is that, let's say that the reinsurer at the end of the deal, if they make profits, so they can actually share some of that profit through profit commissions with the insurer. So the next one, I talk about the proportional insurance coverage. So what are the things that you can actually do to mitigate the adverse impact? So with the proportional programs, particularly what we found was that, especially in cat-prone markets, it was difficult to find the support from the reinsurers because they didn't actually, most of the reinsurers, they don't want to write proportional reinsurance treaties, particularly given that, that a lot of cat events are happening nowadays. So the programs with bad loss experience had actually difficulty finding support. So what we actually recommend our clients to, in that case, is actually to lower their event limits for catastrophe losses and reduce the commissions that actually they get from the reinsurer. And so some of the programs it had actually bad experience. So we introduced onerous clauses like a loss participation clause in which the insurer retain some part of the losses within a certain loss ratio band. I should actually mention that in some of our recent renewals, what we have seen is that some of our clients are actually moving away from proportional treaty insurance coverage. So, and they are going for non-proportional coverage on what we call gross XOL basis because of this, like the difficulty that they find in the market getting the support from the reinsurers. So the next one is actually closer engagement with brokers. So I'm telling this not because I'm working for a broker. So if I take an objective view, I see the benefits actually of reinsurance brokers can provide. So reinsurance brokers nowadays actually move away from, move into like advisory roles, particularly with analytics services that they provide. So part of these analytics services include optimizing reinsurance structures. So as an insurer, you can actually ask your broker to look at your reinsurance structure and see how they can actually optimize it in a way that you actually get cost saving. So rather than just renewing your structures on expiring basis, ask your brokers have a look at your programs and recommend optimal coverage. So don't make their job easy, basically. So the brokers, they have deep market knowledge and they can actually provide insight. So brokers can identify the reinsurers who have quoted in the past and then approach them, to find out the willingness to support their program. And even for the existing reinsurers on your panel, you can approach them to find out, the additional support you can get from them in case there's a shortfall. And we have seen that some of the reinsurers, actually, they sort of exploit the market in a way that they won't actually get into some of the markets. They find that there's not much capacity available. So brokers are in a better position to identify them and engage them early for the support. So I mentioned earlier that the renewal process took longer than usual. So it's prudent to start the process early. So that will actually allow reinsurers more time to analyze their portfolios and then do the pricing work. And even for the brokers, it will allow brokers more time to negotiate with the reinsurers and the terms and conditions, wording, pricing, and even to find support on the other markets. So the last thing actually you want is a shortfall in your reinsurance coverage. For example, last year when we actually dealt with one of our clients, the client actually took longer than expected to finalize their program based on our proposal. So at the end, what happened was there was very little time for us to actually go back to the reinsurer and negotiate the pricing, especially on the pricing part. So the reinsurer knew that there is not much room available right now, and the client can't find support anywhere else. So they refuse to negotiate the pricing. So that can happen actually if you start later. So this time actually what we have seen is some of our clients started the renewal process quite early, like in mid-September, late September. So we had time to analyze their structures and recommend the optimal structures to them. So that's actually always recommended to start the process early. So in conclusion, so what I would like to say that the market is of course hardening. So there are factors that actually contributed to the hardening of the market, like elevated natural catastrophe losses, COVID-19 loss development, and the uncertainty around them, and the prevailing low interest rate environment impacting the investment income of the reinsurers that compelled them to focus more on the underwriting profit margins. So this hardening market is expected to prevail. So if you read articles nowadays in everyone is saying that this hardening market is going to prevail, even at least at a level that they will maintain the rate increases that we have seen, if that's not going to increase any further. So recently, most recent AM Best, there was a news article from them. They said that in the US primary market, for the first 9 months, they were underwriting losses contributed to about $6 billion compared to about $5 billion underwriting profits last year. So you can imagine that, like part of that process will be transferred to the reinsurance market at the end. So we can expect this hardening market to continue further. So what you can do to actually mitigate the adverse impact. So as I mentioned earlier, improve the data quality is one. So look at your reinsurance structures and see how you can optimize them to provide cost saving, and have a close engagement with your brokers. Ask them to look at your structures, ask them to actually optimize them, recommend different structures for you to have a look at, and start the process early to avoid disappointment of having shortage in your coverage. So that should be the end of my presentation. Thank you very much for your attention. I'm not sure I finished it earlier or not.
So it's a little bit earlier, definitely. Thanks for that, Salia.
Yep.
Just a reminder to everybody, you can just put in some questions in the question answer box. I'm going to start with a question of my own, Salia. So you talked about the reinsurance hardening. Are we talking about specific markets within Asia Pacific, or are we talking about specific lines of businesses which are hardening at the moment?
I would say it's overall. If you look at the Asia Pacific market, right? So you see that on an overall basis, there's a hardening of the market for sure. Then, as I mentioned earlier, if you look at number of different lines of businesses, again you see the different kinds of hardening, like cyber insurance, as I mentioned earlier, right? Has seen like 100% of rate increases. And then markets like Philippines, which are cat-prone markets, even though you haven't had large losses coming from that market, you still see that the rates are hardening over there because of the lack of capacity. Because reinsurers are wary of providing capacity for markets like that. And now, like places like Japan, it actually had severe cat events, have seen property, especially in the property line, the rates increasing.
Right. Okay, we have a question coming in. So are you seeing the cost of retrocession rising? Is that factoring into the reinsurers' pricing expectations?
Yeah, absolutely. That's 100% true. So for some of the retro programs, we have seen that the increases are quite substantial. So what happens is actually like markets like Indonesia, if you take, so local market is quite competitive. So we have seen is actually that reinsurers initially, now it is changing a little bit. Towards the early part of 2020, the reinsurers were not actually adjusting their prices according to what the global market has seen. But when it comes to the retro market, because we have to go to the international market to find the support. So the international market is hardening. So that extra cost that they need to pay, right? They need to actually pass it down to their local citizens at the end. So that's what happened, like the later part of the year, especially this year. So we have seen, yeah, definitely. So that some of the rates we have seen going up by over 15%, this adjusted basis, the retro program.
Right. Thank you. I have another question of my own. So when you talk about how insurers can deal with this, a lot of the suggestions are around how you can change the reinsurance structure, increasing deductibles, and so on. Now, all of that will have an impact on the insurer's balance sheet in some other way, maybe an increase in the capital requirements and so on. How do insurers get around that?
Yes, so that's why we always recommend that if let's say that you are looking at changing your structures, do a proper cost benefit analysis using like dynamic financial analysis, what you call sophisticated modeling technique. So what we do is we basically quantify your balance sheet using the dynamic financial analysis. Look at like if you change the structures compared to expiring structure, so what kind of like impact it's going to have on your P&L, profit and loss statement. So that's we always recommend that basically, rather than just let's say increasing deductible, because of course it's going to have an impact on the profit and losses, right? Because you're going to retain more losses at the end, even though they have cost savings from the reinsurance. So it's always recommended to actually do a proper cost benefit analysis using like sophisticated techniques like DFA. So that's why we always say that go to a broker, ask them to do that kind of work for you.
All right. So we have a question now linking to the cat bonds essentially. Considering the increasing in the nat cat losses in the last few years, how has been the response of the financial markets to the cat bonds? Do you see the risk premium on cat bonds increasing?
For the cat bonds, I can't really answer that. I think it's a question for Mehul because I'm not an expert in the cat bond market, because I normally follow the traditional, reinsurance capital markets. So I'm sorry, I don't think I can provide a
No, that's perfectly
equitable
fine.
answer that. Yeah.
Perfectly fine. Okay, so the other one I think is more traditional reinsurance. It says, do you see any reinsurers looking to change their capacity levels either upwards, example redeploying from Europe post flooding, or downwards reacting to low rates on certain risks/perils?
Yeah, I think it's happening because at the end of the day, reinsurance is about diversification. So you need to find out markets where you can actually diversify your risk. So let's say that even like especially European reinsurers, we actually see some of them are very aggressive in Asia market, in Asia. So they even like markets like Philippines, which is a cat-prone market, they're quite aggressive in that market. So surprisingly, when the other reinsurers are quite wary and like limiting their capacity, there are some reinsurers actually, sort of like exploiting that opportunity. So like even to take the example like Thai floods in 2011, like some of the like Berkshire Hathaway, so they went into the market, when everyone else was, getting out of that market after the Thai flood. So they stayed there for a while. They made a lot of profits. After that, they exited the market. So that kind of thing can happen basically. So at the end, you have to look at, like how you can diversify your book of business.
Okay, we do have 1 more minute, so I'm going to squeeze in another question of my own. This is a topic close to me, I guess. So one of the points that you mentioned was how you expect the reinsurance markets to harden further in the next few years. And then we also had a slide, we talked about the reinsurance capacity in the market and how that has still been increasing all the way through. Yeah. How do you relate the two, and how do you think that the increasing reinsurance capacity is going to affect this hardening of the market?
So if you look at the underlying, the reasons for hardening, it's not really the capacity, lack of capital. So the other factors basically like the elevated cat, event losses. So that's going to be a major concern, right? Even going forward, even up to like 9 months in this year, we have seen the European floods and like Hurricane Ida in US. So they have contributed, I think 40 billion USD already, the net cat losses. So in terms of the availability of the capital, I don't think it's going to be a big factor right now for the hardening of the market. It's still that those underlying conditions are going to be like low interest rate environment can be another one, because it's going to impact your investment income, right? So having said that, again, if you look at markets like Philippines, cat-prone countries, you will see that there's a limit of the availability of the capital capacity is going to be limited. So it again depends on the the region and the pockets of market you are looking at.
Right. All right. Thanks, Salia. I don't think we have any other questions for now. Thank you so much for presenting here, and this was a very interesting topic. Yes,
okay,
at least
thank you very much.